has come and gone, and we're left with one clear message from the Fed Chair Janet Yellen. Labour markets cannot take higher rates. Economies still need time to heal. As we look ahead to the US GDP on Thursday, let's debrief with the chief market strategist at ADS Securities, Nour Al-Hamari, who joins us from Abu Dhabi. Great to have you with us this morning, Nour. I was surprised when I looked through your notes. You say Jackson Hole was a waste of time. We awaited Yellen's comments on the labour market, and she didn't go into any detail. I mean, that's very different to the conversation that Mark and I have just had for the past 30 minutes with Lena Komaleva, saying very clear messages coming from both Draghi and from Yellen, yet you would suggest it was a waste of time.
Yeah, well, basically, but we were waiting for Janet Yellen, as she is a labor market analyst, to come in and to tell us what she thinks about the participation rate. We're still below, at 1973 lows so far. Okay, we know that rates cannot go higher with this kind of a situation. Also, we were waiting again for her outlook about what's happening in terms of the quality of jobs. Most of or more than 70 to 80% of the jobs that were created since the financial crisis until today, they are low-wages jobs or temporary jobs or part-time jobs, while the full-time jobs is still very weak comparing to historical standard before the financial crisis. So it's basically, we all know about the slack that is in the labor market. So I was looking for more information, for more explanation why the Federal Reserve took the latest statement saying that interest rate may rise sooner than expected. And right now in Jackson Hole, we've seen another dovishness from Janet Yellen saying, okay, we have the slack in the market. Everybody knows that there's a slack in the market, but the question remains how the Federal Reserve is going to act toward this slack, and what's exactly the steps that the Federal Reserve will consider before raising rates. So this is the things that.
But I think actually, to be fair to Yellen, Nour, to be fair to Yellen, she does actually say keeping policy highly accommodative until inflation pressures emerge might unduly delay the removal of accommodation, necessitating an abrupt and potentially disruptive tightening policy later on. So she does tacitly move. I mean, there's a very distinct move in terms of what she's saying to the markets. Would you not agree? And she does talk about the 19 indicators in terms of the labour market and those being underemployed. So I think she did actually give some fairly robust guidance, no?
It's kind of fairly robust. I might agree with that, but again, we should look at the historical standards and how the labor market is acting since the financial crisis until today. The unemployment went down, that's right, to 6.1%, but again, it went down because of the declining participation rate, and you have a lot of people leaving the labor force. And again, last month we've seen another upside, a tick higher, in unemployment went back to 6.2 because the participation rate went up again due to the the higher consumer confidence in the market. So basically, if we continue with this path, higher consumer confidence, we're going to see more and more people going in back to the labor market, which might also lead to another rise in unemployment rate. This is the things that I'm looking at it right now. But despite the improvement, let's say, in the labor market, what's so-called improvement, we still need to look at the participation rate, which should go higher before any rate hike. Otherwise, we're going to go back into the same dilemma where the participation rate continues to go down, and we'll say that this is an improvement while the labor market is shrinking, not expanding.
No, we've had many years of unanimity within Jackson Hole following the financial crisis. This year we've got divergence because the world's leading central banks are going in their own directions. The BOE and the Fed on one side, the ECB and the Bank of Japan on the other. How are investors, how are markets going to withstand this divergence of policy within the world's leading central banks?
Yeah, well, this is another thing that we noticed in the past few weeks or the past few days in Saudi Arabia. Right now they're opening the market to foreign investor, which is it's going to be another way to diversify, or the investor might diversify after the kind of a different approach that we're seeing from the central banks. Right now we have a few days ago the SMA announced that it's going to open the market to foreign investors. However, some might say the ISIS troubles in the region will be another another thing like to be considered. But look at the historical standards again. This region, especially in the Gulf region, it having like very stable, and this is the things that to consider. Also, have a look at Abu Dhabi and Qatar, Dubai. So these kind of markets going to be another potential for foreign investor amid kind of this different approach that we're seeing from the central banks. However, also going back to the major central bank. Still, if you look at raising rates right now, it's going to be very difficult. It's going to be very different from any other rate hikes before, because you have a different approach. You have also, again, the economic recovery is not leading, or it's not doing, or the QEs at least across the globe, it's not doing what it's supposed to do. Since we've seen most of the GDP numbers are coming disappointing and less, or way less than the central bank's targeting. So, this is kind of things to consider.
Nour Al-Hami, Chief Market Strategist at ADS Securities in Abu Dhabi. Great to have you with us this morning.